Hi, it's Matthew Holt here with a quick THCB Spotlight. I'm here with Shahram Seyedin-Noor, whose name I hope I didn't butcher too much, Shahram, who is the, I won't say general partner of Civilization Ventures, but the king over there of Civilization Ventures, which is a relatively small fund that he's been running for a while. And it's very notable in THCB world because it's where Zoya Khan, who used to work at THCB, just left and is now an associate, or an analyst, or whatever the ranking is you have with that. So Shahram, great to meet you. Tell me a bit about how you got into venture and what you were doing before that.
Great to see you again, Matthew, and thanks for spending some time with us. And thank you for training Zoya Khan and helping bridge her entry into Civilization Ventures.
You actually did mention that we should talk about soccer. I like the whole theory about soccer transfer fees, where when you get one of a lower division player, you then the big club pays the big number, and then if you sell her on to A16Z or whatever, you get a cut. I get a cut of that, and you get a cut of that as well.
I like that.
It doesn't work like that somehow in Silicon Valley, but it should do.
That's it. Well, hopefully we'll be as big as them at some point, so we won't lose anyone.
That's another approach. Right.
And in fact, as you know, we're very friendly with Andreessen because they're co-investors with us in Omada Health, right, and some other companies as well. So we really like those guys. But how did I get into venture? I think was the question.
Yeah.
I didn't start my career really knowing what venture was. I started my career 22 years ago now as an attorney. After I graduated from law school, I came out to the West Coast and worked. I was raised on the West Coast, but I went to law school on the East Coast, came back here, worked at Wilson Sonsini. Spent about 4, 5, 6, 7 years doing law and banking at Wilson Sonsini, Cooley, and Goldman Sachs. Learned the ropes when it comes to some of the business dimensions of what we do, and that's when I realized what venture capital even is, because I was representing venture capitalists, but I wasn't interested in it back then. I was interested in entrepreneurship. Really, I was interested in entrepreneurship since I took the class with Lawrence Lessig and Jonathan Zittrain called the High Tech Entrepreneur at Harvard Law School, which was the first year it was being taught. This was while Professor Lessig was the special prosecutor on the Microsoft antitrust case. And so that whole class was just go start an online business. So I did that with 2 of my classmates, and it was wonderful. And that got the taste in my mouth. But of course, I graduated. Unlike in England, we don't have great public institutions that are cheap here. In general, you pay a lot.
Even noticed. And so education and healthcare are kind of similar in that way, right?
Exactly right. And so I graduated with a non-trivial amount of educational loans that I wanted to repay. After 7 years, I did that and had a bit of a savings account. And that's when I took the risk of joining startups. And I think after 10 years of starting companies and running them as an executive, that's when I decided that the time was right for me to start a venture firm, mainly because I saw strong product market fit, to use kind of founder parlance, between my skills and my passions and what I thought was the demand out there for a new type of venture capitalist in our sector. Of course, as you know, this idea of digital health, depending on how one defines it, has either been around since the beginning of software or is very new. So if it's just software and healthcare, it's been around forever. But if it's digital care, what Omada and many of its peers like Lyra and Hinge Health and others are pioneering, then it's a newer type of sector. And of course, with Rock Health's digest or newsletter every week, it looks like they include a lot of things in digital health. So it's it's like practically the entire healthcare economy. And so I wanted to be a venture capitalist after spending 15 years as a service provider and then as an entrepreneur. My first company where I was an executive was NextBio out of Stanford, was acquired by Illumina. Then I started a cancer therapeutics company called Argenx, which is in phase 2 trials for oncology. And I felt like I had learned enough hard lessons. I had enough scar tissue and some successes that I thought, it would be so much fun to give back to younger entrepreneurs with my experience and support them. And most importantly, Matthew, I saw the emergence 5 years ago when I started Civilization Ventures of a new type of life science and healthcare entrepreneur. And by that, I mean kind of younger, oftentimes PhDs or dropouts, perfect case in point. The founder and CEO, co-founder and CEO of Omada Health, Sean Duffy, dropped out of the Harvard MD MBA program to begin Omada, and I was privileged to be their first check when he and Adrian James teamed up. And so I thought this is kind of a new phenotype for an entrepreneur, especially in the hard life sciences sectors, where normally the big VCs will start companies and hire very senior executives, a little bit older in their 50s and 60s, as opposed to young guns. And so I wanted to support that phenotype. I thought there was a need for it in the market. And I defined my investment thesis to be very specific to areas where I didn't think there was an entrenched leader. Perhaps you'll contest me on that. But if you ask me today, what is the leading venture fund investing in digital health? I mean, what is it? We don't really know. It's obviously, big funds dabble. The traditional biotech VCs don't really touch that arena. They're really focused on small, large molecules, now gene and cell therapies as well. But I thought, okay, if I focus on digital health and artificial intelligence in healthcare, synthetic biology and genomics and diagnostics, which are the areas where I happen to have a lot of experience, both as an investor and an entrepreneur, that's going to be a unique mandate for a microfund, and something that I could have a big impact on, hopefully, in the industry. And that's why I started the fund.
That makes a lot of sense. So the one question I ask a lot of people who do both sides, and you mentioned most people don't do both sides on the kind of what I call email your doctor versus curing cancer, right? Is that one side requires a lot of very specialized knowledge, right? So to know about biotech, genomics, synthetic biology, and all the derivatives there are, requires a lot of specialized knowledge. The rest of it, the other side, is kind of trying to make business common sense and use technology to change healthcare.
Exactly.
Now, there's an incredible amount of detail and complexity once you get into it, but most people can if I explain to you what Amada Health did, the person off the street would understand it. I suspect if I look at the rest of your portfolio and you try to explain to the person off the street what they do, they'd hold up their hands and wouldn't guess. So how do you manage those two different sort of banks of knowledge?
Well, it's a very good point. So as you know, I'm not a scientist, and I don't play one on TV. That's why we have Tamasib Khan, our VP, who's a PhD from Stanford. And of course, Zoya has a neuroscience undergraduate degree as well. I was a pre-med for a little bit in undergraduate and had a real strong, and still have a very obviously enduring passion for deep tech and genomics. And that's why I do a lot of reading. And I'm kind of an autodidact in that sense. But I would say that there are different animals, and the metrics we measure in gauging whether to invest in a company across those sectors are very different. But actually, it's not hard. I mean, if you think about it, there are so many subsectors, even within hard, deep tech. It's not just that you're investing in drugs. You're investing in either a small molecule, which requires medicinal chemistry, or antibodies, or peptides, or gene and cell therapies. These are all very, very different as digital health would be from them. So in a sense, the commonality is my passion and where I saw the market opportunity, not so much expertise, because expertise you learn. And as you said, I think correctly, digital health probably among those is the most intuitive, where a layperson can readily understand it. So the barrier to entry in investing in digital health is extremely low. But for the same reason, the flip side of the coin is that for us, the activation energy for making an investment in a digital health company is a lot higher, because everything sounds cool on paper and everyone can create an app, but or a solution or a platform. But if you're to really interrogate it, you have to understand, why do you exist? Where's the product market fit? Who's going to pay for it? Where's reimbursement? Where's your specific expertise? How are you differentiated? What's your barrier to entry? These are just natural heuristics and a framework that we use when we're speaking with founders. And we do find that the types of questions we ask obviously are different, but the level of rigor is not, because it just shifts to different things. So in digital health, we focus more on traction to prove product market fit. Whereas in therapeutics, there's a product market fit if your drug works. So you're really focused on the technology scrutiny of understanding if the drug could work. Digital health, you assume the software works, and you're really curious about, well, who's going to pay for it? Why is your musculoskeletal remote solution, digital care solution, better than Hinge? How is it better? Who are your customers? What is your growth rate? It shifts more to kind of business level questions to understand the product market fit. So in that realm, as you know, our investments include Omada Health, where I was the first angel, but of course our fund subsequent to that recently has invested quite a bit. Lemonade Health, your countrymen. By the way, the English are very prominent out here.
It's cold and rainy in England, so people don't move and go to California.
Well, Symbio Beta is led by a great guy. I'm sure you know John Cumbers. He's also your countryman, and you're dominating the digital health arena. And Lemonade Health was founded by people from England as well. Paul Johnson was an executive at Lloyd's Pharmacy who helped integrate their purchase of Dr. Tom's, which was founded by his co-founder for Lemonade Health, Ian, and his brother. So we have a lot of very prominent English entrepreneurs in our portfolio, but in particular, Lemonade Health has now expanded back out to England from the United States with the partnership they announced with Boots, which is one of the largest pharmacy chains in England, to do a kind of telemedicine solution for them. So Omada, Lemonade Health, Curai, founded by Neil Costa and run by him, very, very smart young executive who I think will change the face of healthcare, now backed by Morningside and others. We were fortunate to be one of their early investors. We're about to announce an investment in another company in the next few months as well. So our portfolio in digital health is growing. The criteria we use to evaluate it is different. And I think in some ways it's harder to prove yourself to be a worthy investment in digital health because you have to show some type of traction. It's generally going to be hard for us to write a check without on just a PowerPoint.
Right. So right now your portfolio is, I'm guessing sort of 75 in the synthetic bio, applied biology realm, and about 25 in digital health. My numbers might be off there, but
yeah, that's fine. Right?
So two questions. One is, do you anticipate that staying that way? And the second question is, you're a relatively small fund that invests a lot for the size of the fund you are. What we've seen in recent times in digital health, you mentioned who are the leaders. Well, if you look at pure money spent, right? The Andreessens, the General Catalysts, the Oaks have been writing and Tiger for them have been running several $100 million checks plus, and they've been doing these big rounds of 200 million, right? Do you think, so first question is the ratio between the sort of life science stuff and digital health. And the second is, do you think there's still a role for a small fund like you, or do you have to go out and raise a much bigger fund to be able to sort of play the way it's going today?
Good questions, Matthew. So I would say the target ratio we're going for is probably a third in digital health, a quarter to a third, just because we have three kind of pillars, as I mentioned earlier. So that's the goal. And I think we're tracking to that. I think there's more need than ever before for smaller seed and pre-seed funds, precisely because the other funds are so big. So if you think about it, if you're managing $1 billion and you have 5 partners, what's the point of writing a $200,000 check or a $500,000 check? You really can't justify sitting on a board or helping a company where you've put a small check when you really have to watch your portfolio where you have $20 million bets to perform and to serve your LPs. So the bigger those funds get, the better it is for us in a sense, because there's more of a need for mentor capitalists, as we call ourselves, for earlier seed stage founders. Having said that, I don't want to shortchange us because, as you know, we've announced our second fund, which is $35 million. We announced it last year, and we're investing out of that now. It's about a third invested already. But we also have a growth vehicle that we haven't announced, which we'll probably announce later, that allows us to invest later stage. So we've invested in. I personally, and subsequent to my starting of the fund has invested in every single round that Omada Health has ever raised. So obviously we have a lot riding on it, fingers crossed, but those guys are pretty fantastic. And we did it through our growth vehicles. So we intend to continue doing that. Our total investments to date are between 50 and 100 million, which is more than we've announced. And we hope that it will be substantially above 100 million in the next few years. So that's where we're headed. It doesn't distract us from the core mandate of mentoring and helping early stage entrepreneurs, because the growth investments are in existing portfolio companies, by and large, 90%, 95%. So it's just a question of investing in a company at the seed, pre-seed level, and just maintaining the firepower to continue supporting them when they raise their 50 or $100 million rounds.
That makes a lot of sense. So let's talk about the other end of the VC business, which is the exits. We've seen a lot more the last couple of years in digital health in particular. We haven't seen a Omada exit yet, which some people are surprised about, but many of their competitors you mentioned have done that. We now have the route of the SPACs. Some of them have gone okay, some of them have gone not quite so okay in the last few months. And you've obviously got got some really intense IPOs with some pretty weighty valuations for companies that are losing money. Where do you, I mean, obviously the whole pipeline is dependent on that sort of keeping going now, but where do you think that goes for the next little bit? And do you think we're going to see the valuations in the public markets stay the way they are? Or do you think they're going to cool off, and will that reflect back in the private markets?
That's an excellent question. It's actually pretty foundational to the perspective of an investor, because you have to invest not just based on technology, but based on returns. I mean, at the end of the day, we won't survive if we're making continually poor investments based on lofty valuations that are not supportable long term. So you're correct that there's a strong nexus between public and private markets. There's a little bit of a lag effect, and I think that you're also correct, if I'm reading between the lines, that the public markets are a little bit overvalued in some areas. I would say in probably more than a few areas. We see diagnostics companies today that are valued in the billions, and they have no revenues or product. We see digital health companies that are going public with revenues, but their revenues are, the multiples applied to those revenues or earnings, if they have them, are way above historic averages. And that's basically based on the phenomena, in my humble opinion, as a former banker and an econ guy, that money doesn't know where to go right now. Interest rates are zero or negative in some parts of the world. And there's a lot of wealthy individuals and family offices and more funds than I could count on one finger, almost an infinite amount of funds these days that are vying for investments, and that drives up valuations. And that's, I think, the phenomenon we're witnessing. But eventually gravity takes hold. And if companies are going public via SPACs with just future forecasts that are lofty, at some point, the chickens come home to roost, and you say, well, that was a year ago. You promised X, Y, and Z. Why hasn't any of it happened? And even the most gullible of investors will have to, scream uncle and sell their shares at some point so they don't take a complete bath. So I started my career in '99, and I was there for the dot-com bubble. And I was one of the very few people at Wilson Sonsini at the time that was, at least that I remember, saying that this is an obvious bubble. I remember one of the partners in my group was a great guy. I was a first-year associate, so I was very low on the totem pole. I went to him and I was like, this is a clear bubble we're in. We're taking these companies public. I was doing M&As, I was doing IPOs, I was doing venture financings 7 days a week, 24 hours a day, living in the office. And I was at the printers. The printers is where you used to go. I don't know if they still do. I think they do, where they literally print the S1s and the prospectuses for IPOs. So, back then you'd go to the printers at night as a lowly associate and kind of work with the bankers and the entrepreneurs in writing the documents, and you would have the free sushi they would provide, Donnelly or one of the printers, and you would just, it was very exciting. They had CNBC playing overhead. But as an econ major, especially one that had focused a lot on mathematics and statistics, I thought, this doesn't make any sense. There's no reality grounded to these startups. And one of the IPOs I was working on was Garage.com. So Guy Kawasaki, someone who may not, I don't know if you know him, we were in a room and I was a first year associate kind of, quizzing him about, how did you get here? He's like, well, I used to work for Steve Jobs and blah, blah, blah. He's a really nice guy. And I just thought, like, man, these guys are going to become billionaires. This is going to be quite the IPO. That IPO was one of many that was pulled when the music stopped. And so I think we're in a similar environment today. It's not quite as frothy because we do have, for folks like me who have a little gray hair, we remember those times. And so that disciplines us a little bit. But I think we're headed in that direction in some subsectors. Having said all that, we're in a period of fundamental change as well. I mean, the way Omada and its peers are changing healthcare, that's not transient. Their revenue growth is not trivial. Omada now has, I don't know if they've announced the number of customers, but it's crazy how many enterprise.
I heard 500,000 have been through the system, and I think when Luongo was brought up, it was about 350, 400 were on their platform. So it's real numbers, although there are a lot more people who need it.
I don't know if they've announced, but the number of enterprise customers they have, just the sheer number of companies like Costco and United is crazy. Yeah. It's really crazy, and the growth rate of those customers is crazy. So, that's a testament to that team's execution. And again, we're privileged to play a supporting role there. Although we interact regularly with the founders and help them think through some strategic questions as they require. But I think that company, I think Omada will be a $10, $20 billion company in the next few years. And I think we're seeing that throughout the industry. 10 years from now, that company should be dominant with its peers. I'm not trying to pretend they're better in every category than others, but I think with their peers, they will transform U.S. healthcare for the better. So I don't think that's transient, but I think the short-term valuations that we're seeing with some of these IPOs are not necessarily tethered to traditional valuation metrics. And so that makes the job harder for us as investors to be more cautious. But again, money has nowhere else to go. And as they say, money doesn't sleep, to use another cheesy cliche. So if you're a billionaire, which, you know, some of the investors in this space are, or funds that have billions to invest, you got to put it to work. And if the asking price is that you're investing at a 2 billion valuation in a company that has 10 million in revenues, I guess you just got to hold your nose and do it if you're those guys. We don't do that. We do not do that. We think we're too small and too new to make those kinds of mistakes. There will be other mistakes that we make. Don't get me wrong. We're not going to be perfect by any stretch, but hopefully we'll avoid that mistake. Because as an angel investor in the past, prior to starting this fund, I took my meager savings account and was supporting friends of mine that were starting companies. And I was very lucky to have a few exits from that, but I learned some lessons as well. And valuation is certainly one of them.
Right. Okay. Last question, Shahram. Where do you think, where are you looking now, especially on the digital health side and also on the bio side, but what kinds of areas are you looking at that are exciting to you?
Within digital health?
Primarily, yes, because I wouldn't understand the answer.
I'm super excited about the elderly market because it's the fastest growing demographic in the United States. Obviously, my father's 82. He just, touch wood, he survived bladder cancer, and we actually diagnosed him through one of our investments. Convergent Genomics helped diagnose his cancer, where the doctors were befuddled. So it just shows you, again, the value of our portfolio on the science. But now I would like to find my parents who are not very computer savvy a digital solution that could help manage their health. I mean, I was having dinner with my parents last night, and I'm still my mother's IT person. It's like, why is Gmail not working? And I just look at it, it's like, okay, well. And then when you look at their Gmails for some of the elderly, it's like it's dominated by promotions and spam. So I just think that, there needs to be a clean, easy solution for the elderly market. We actually had an investment in the company called Pillow Health. I don't know if you're familiar with them, but it's kind of like your Amazon at home device, but it dispensed pills. Wonderful, wonderful founders, James and Emma, just salt of the earth. One of their investors was Stanley Black & Decker, the power tool maker, and they ended up acquiring the company last year. I don't think the company fulfilled its full potential, to be honest. I think it could have been much, much bigger, but we were grateful to see the exit. And I think a company like that takes something so foundational, like taking your medication, which for older Americans is, older people is a real issue. They miss it, they forget. And just, if you solve that in a way that's plug and play and intuitive, you're just going to crush the market. And we haven't quite seen that yet. So we're actively on the hunt. Send us your companies, Matthew, if you see me. That fit the bill.
If I see a few, I'll get about, but I think that's great. I mean, I think fixing that sort of elderly caregiving connection, medication management, care management piece, I mean, there's going to be a lot of effort continue to be spent in that, but clearly we've not cracked it yet. And I think we've probably spent more effort on the chronic care management side, the Amadas and the Livongos, than we have in that area. And I think you're right, as the population continues to age, and as we've seen, with COVID, we have these issues with loneliness at home, and companies like Papa that are coming in to like solve it using using humans rather than technology. It's very interesting the way to say that market will develop, because we have done a lousy job of sort of caring for those people, and COVID really exposed that. So it's going to be very, very interesting. All right. Well, look, really interesting, Shahram, to chat with you, find a bit more about your history, a bit about your investment philosophy. Thanks for your time. Please look after Zoya, and we'll look forward to seeing how you'll come back and tell us how all those investments paid off in the next couple of years.
Thank you very much, Matthew, for your time. It's such a pleasure speaking with you. Hopefully, you and I will meet in person soon over some beer or coffee, whatever you prefer. And we love your podcast and your broadcast and all the things you do. And you're such a leader in the industry. So thank you so much for having me.
Appreciate your kind words. Thanks so much.